Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, June 9th, 2020. It is 12:30 p.m. Eastern Time as I'm starting the video, and there's several things I want to point out today. The main goal of this video is to cover the broad markets, maybe treasury bonds, those things related to risk-off assets. So I want to get into that, point out what I'm seeing, especially the divergence today between the NASDAQ 100 and the broad, pretty much everything else, even within the NASDAQ 100. I want to talk about market breadth. Again, seen some developments that are fairly recent, some potential cracks here in the market. But I want to start out with trade ideas. I did just post an update on this today. CAN broke out, and it wasn't a gap away breakout. There was plenty of room. You can see here, this is a 1-minute chart, what I'm showing you, and this is where we closed yesterday. So it gradually has been moving up all day. One point today, it's been as high as almost 20% there. So there's that breakout. Again, I'm just following up on trade ideas. I'm trying to keep focus now, to the best looking trade ideas, long or short. And the other thing nice about it, I don't know if you can make it out there, volume is nice today too as well. You have a pretty decent volume. What is our volume today? We have there it is, 5.5 million shares so far, so which is tracking real well. So anyways, as long as the market rally, and it doesn't have to. This is not a top component of the S&P 500. This is a relatively new company. It started trading back here just at the end of 2019. So anyway, I'll move on. And I did give you guys some potential targets that I hadn't had on there before. Unadjusted targets. I'm keeping this unofficial right now. A lot of cracks in the market. It's I'm viewing this market. It's like a game of musical chairs. Play these long side trades as long as the music's playing, but don't be the last one at the party once the lights go out and everyone leaves. Meaning once the momentum shifts. But from here alone, from the breakout, let's just go from there. From the breakout today to that first target, that'd be about 26% of hit, then 45, and potentially up here about 82% if that third target. That's all I'm looking at right now, max target. And again, as long as the music's playing, this is one of the better looking setups. Now, for the life of me, I don't know how I missed BGG in the yesterday's follow-up, because what I did is I went through all the trade ideas I posted over the last week or so. I did a video on longs and a video on shorts. This one I just covered on Friday. In fact, here it is in the video with the trade ideas. BGG, Friday's video right there. I think that's Friday, the June 5th. Yep, that's Friday. So we're just breaking out of dual downtrend lines right there, intersecting downtrend lines. We were at $2 a share at the time. We had some minor resistance at 202, and I was highlighting these targets here at the time, pointing that 280 target, and that one was hit. So let me go back to the chart here. Again, should have updated that yesterday. That's a quick 45% gain. Very objective time to book profits, because that's a pretty significant resistance level. So from where we were the other day, was right there, popped up, and about a 45% gain right into that second target. Beautiful, reaction so far. One day we stopped pretty much right there, and now we're pulling back today about 8%. So it's a breakout. May have more to go. It all depends on the market. But again, I feel pretty confident we're much closer to the end of this rally than anywhere else at any other point. In other words, not in the beginning of the rally, not in the midpoint. There's just a lot of things starting to build on the charts. And again, point of this video I'm about to roll into, showing you some potential cracks, developments to look for. I always say this: one day does not make a trend in the market, nor does just a couple days here. But I'm going to go over those things that I'm seeing right now. Just wanted to update BGG and CAN for those of you that may have taken the trade, and you can see the potential other targets there. Okay, so what do I want to cover? Let's start with what's going on in the market today. We have a nice rally. The NASDAQ 100, which again, I always say this, it is an index, technically speaking. It has 100 different companies in there, but it's not a very diversified index, and it's most certainly not representative of what's going on in the U.S. economy. It lacks key sectors such as financials and other things. It's pretty much a tech index. Mirrors XLK, because the majority of the returns, over 50% or so, come from technology alone, the tech sector and tech stocks. But it made a new high, and that's what's strong today. That's what people just can't get enough of. They're bidding these companies up like they are immune to the business cycle. The business cycle has turned by every metric, every single metric known to fundamental analysis, economics. We've started a recession. We're in it now. Last week's jobs number was good, but there's a lot coming out now in the media, financial media that shows that it may have been severely skewed. Whatever. We'll take it for what it's worth. Let's just talk about the charts right now. You and I can debate all day long whether the economy is going to roar, come back to 100%. When you look at stocks that are at new all-time highs, that is indicating that the market believes, now right or wrong, they're pricing those stocks as if those companies are in a better position than they were before they peaked back here. In other words, that's the way you have to look at it. Are they more profitable, or their future? It's really more about the future growth prospects. That's what the stock market's all about. It's not, you can take a valuation. That's what a lot of people do, try to take a screenshot of what their current earnings are, and that's a little bit dated. You're looking at last quarter's earnings and growth rates and all that. But all right, let me get back to what I'm going for here. All right, so we have QQQ up 0.65% today. Pretty respectable, especially following the breakout to new highs and continue to build on those gains. Still above this little minor trend line here. Yet the stock market itself, SPY, was probably the most accurate measure of the entire stock market or the U.S. economy, because it's 500 companies diversified among many sectors. And although technology is a big component, about 25% is the largest sector. It's not half like it is in the NASDAQ 100, and of course then you have other sectors as well. In fact, you have 11 sectors within the SPY or the S&P 500, and there's subsectors within there as well. All right, so we're down. That is a very big divergence between the two. And in fact, here it is. The Qs or NASDAQ 100 is up about 0.7%, and the S&P 500 or the stock market's down about 0.7%. Now, it's not just one or two things knocking it down. This is broad-based selling. Again, this is, it's been the common theme. We all know that XLK and tech stocks have been, they were the strongest sector throughout the entire previous bull market leading up to the February highs, off the 2009 lows to the 2020 highs in February. We're still below that high, so we're not we can't say this is a new bull or a continuation of that old bull market. Again, those whole definitions of bull bear market, like I said, kind of, in my opinion, get thrown out the window, because the moves now with such massive central bank intervention in the past decade have led to unusually large and long trends. And I think the old definition of a 20% rise, rally, or drop in the stock market as constituting a bull or bear market, I think that needs to be revisited. I think that things should be looked at in other terms, such as the percentage of the previous run-up. You can look at retracements, Fibonacci retracements, or just straight out percentage retracements. And XLK, I wanted to point out, is the only sector up today. It's also up on very low volume. You can see the volume buzz there. Every other sector is down, and down pretty good, not just down a little. You have the heavy selling, at least a big drop, not huge volume, but in XLI, the industrials down 2.23%. Financials are down 2.4%. Utilities, energy is down 4% today. So as you can see, a sea of red. These are the percentage gains right there in all 11 sectors. Let's take it a step further and do this. So we go back to QQQ. You say, okay, well, Randy, it's all about tech. Well, remember, the problem with QQQ, not only is it not a diversified index, not by lacking many key sectors and having an overweighted concentration in technology and a lot of stocks, the way it's weighted is the FANGs, those top 5 components, have a huge impact on the returns because they're heavy weighting. So what you do is just add an E to the end, QQQE, and that brings up the equal weighted NASDAQ 100 ETF. And that just applies an equal weighting to all 100 companies in the NASDAQ 100. The same companies, but it strips away the what I think is the an excessive weighting towards those large market cap companies, and then you're down 0.6%. This is unusual to see the NASDAQ 100 up about 7/10 and to see the equal weighted down. And when we look at that, let me pull up a watch list of the components here. Okay, now we're going to take a look under the hood. We're going to look at market breadth. We're going to look at the stocks within the NASDAQ 100 that are driving this rally. In other words, we'll look at the ones advancing versus those declining. So the first thing I've done here, this is a list of all 100 stocks. You have to scroll down to see them all, but I've sorted them by market caps. You have the big fangs up top: Apple, Microsoft, Amazon, Alphabet, both share classes, and Facebook right there. And you can see that's what I dubbed the FANG, FAAMG stocks. I don't include Netflix because Netflix is not nearly as big as those. It's only a $184 billion company only, but these are trillion-dollar companies or close to it. Much bigger, and as such, they have a much larger impact on the returns of the NASDAQ 100. So what you can see here is they're all green, and they're green by a lot. People cannot get enough of these stocks, and you might say, oh, that's a good thing, right? These are leading companies. No, every time you've had a major top in the market, or even when they've gotten ahead and done this for a while, there's a pretty good reversion to the mean. It is unhealthy. That's what they call market breadth. When you see fewer and fewer stocks doing the heavy lifting, in other words, and bringing an index up or the market. And remember, these are also the top components in the S&P 500. They're just not as heavy. They don't have nearly as heavy a weighting. And so another thing, in a minute ago, I showed you how the equal weighted NASDAQ 100 was down significantly. It was down about as much as the NASDAQ 100 is up. NASDAQ 100 being up 0.8%. So let me go back to that list and show you one other thing. A few years back, I figured out a way. One of the tools of technical analysis is market breadth. Well, problem with that, on most platforms, the market breadth data is lagging. It's reported every half hour, sometimes every hour, depending on what platform you're looking at, and so you're getting old information. The other thing is you only get market breadth data on the NASDAQ Composite, NYSE, and the NYSE. Typically, you don't get it on the S&P 500 and or the NASDAQ 100. So what I've done is come up with a way to see instant market breadth. And again, I did a video, but I'll show you. It's really easy. If you have TC2000 or maybe a similar platform, all you have to do here is sort by percent gainers and losers. So now I've changed my watch list, and so I can simply go down here, click on the last stock that's green today, and that tells me at the very bottom you see 35 of 103 items. Well, you might say, why are there 103? Some companies like Alphabet have more than one share class. Alphabet has GOOG and GOOGL. And so that tells me of the 103 companies in there, 35 or 1/3 of the companies are trading positive, or another way to look at it is 2/3, a vast majority are trading in the red today. And again, I have to say this, and I said it before, it bears repeating. One day doesn't make a trend, but we'll watch this. And if we continue to see this breadth deterioration, and there are some other metrics that you can use, such as the percentage of, the AD line, advancing versus decliners, on stockcharts.com, the $ NAAD, the NASDAQ advanced declining issues. And there's a lot of other things out there. And I have been seeing that lately, that a lot of the big names are doing most of the heavy lifting. And that's certainly happening today. And even drill down a little further when you look at that. Look at which ones, when I sorted them by percentage gains, you can see it's your biggest ones up there. There's your Amazon, Facebook, all near the top. Netflix even up there. A lot of those big names are up at the top, the big fangs doing the heavy lifting. Your bigger, and when you go down to the bottom again, just a lot of underperformance in the majority of stocks down there. Okay, another potential red flag in the market, and something I've highlighted yesterday. On Friday, I pointed out, as I was recording the video at the time, that the TLT had fallen down real close to this 152.62 support. At the same time, and more importantly, ZB Treasury bond futures were at a key trendline support while oversold at rarely seen oversold levels. And so far, they've rallied hard. That's a pretty big rally. Now they'd had a big drop before then, but the fact that they're not just consolidating, that they're reversing very hard. It's about 4.25% since that mid-session low on Friday so far on TLT. That's a pretty big move in TLT. It's nothing like you saw back here. Remember, this is an almost unprecedented period of volatility. So don't look at these candles. Go back in time, and you can see it's a pretty decent move. And again, one day doesn't make a trend, 2-3 days doesn't. But as each day goes on, what it's telling me is whether it's just a reflexive technical bounce, and it may be. Again, that was highlighted back then. We go to ZB, and we were looking at a 2-year daily chart on Friday. And so I pointed out the oversold readings. That's oversold like we were back there, which is right there. Oversold here, and those are where we bounce. So certainly the case could be made and was made for a technical bounce, a reflexive bounce. That may be all it is so far. And there's still some pretty big resistance up here. But when you go back, let's look at that so we can kind of gauge where Treasuries might be heading. For anybody trading those, we'll go back to the hourly chart. And we already hit it. If that's a valid candle, that's a back test to that range right there, that multi-week trading range. But I just wanted to point out that they are up today, and so is gold. We go back to GLD, the gold ETF. Nice move today, and gold has held support. Where I had on the 60-minute chart of GC gold futures a slight breakdown, you can see so far gold has snapped back, and that was something that was pointed out. We had divergences in place when the gold futures broke this trading range, and we really came down to, you can see on GLD. Remember, we never closed on a daily closing basis below that 158. That's the key support that I've had here, and we covered recently. We had a intraday, well, actually a slight close below it there. This was only an intraday break. So far gold on this daily time frame has successfully held and defended that, and has been rallying and is up about 1% today. Again, flight to safety instrument. Is it just a reflexive technical bounce, or is this institutions, smart money, maybe even the retail and traders taking profits on longs after such a big run up and moving into safe haven investments? Either way, take it for what it's worth. That has been the case for the last few days. And if the stock market was still rallying, S&P 500, if we didn't have 10 of the 11 sectors trading red, the vast majority of stocks trading red, what I don't think I did for you is showed you the breadth in the S&P 500. Let me do that. I showed you the NASDAQ 100, and let's do it for the S&P 500. So again, we sort by, well, let's just go by losers. And I scroll down. Here, let me move that list up where you can see the bottom. There's 505 stocks in there. Remember, some of those you have different share classes. So 500 companies. And I'm scrolling down and down. You can see here, this is showing you how many are trading down. Vast majority in the S&P 500. My goodness. We are down here. This is our market breadth today. 433 out of the 505 stocks in the S&P 500 are trading in the red today. Look, is it just a down day? Yeah, it is a down day, but it's also broad-based selling. Recently, we were seeing a lot of, bullish action across the board, broad participation on the rally, but things are starting to change. Again, at least today. So take it for what it's worth. I'm pointing out these cracks. That continues. And now from here, like I said this morning in the update, what I want to do is start watching the support levels. On the daily chart, we have this primary trend line. We have SPY that has ran into that big gap, very significant gap back there from February 24th. The bottom of the gap stopped there so far. Now on a daily chart, is that a check mark for the bears? No. You'd have to break this trend line right there. So far, it would almost be, surprising if we didn't have at least an initial pullback on the first tag of the bottom of that gap. So this is perfectly normal so far. The broad-based selling in the divergence between the S&P 500 and QQQ is what stands out as a little odd. This isn't just a normal pullback, but it hasn't done any technical damage, at least not price-wise on the chart yet. It's just a little relatively small pullback within a very powerful uptrend. So we watch this trend line. That would be a significant technical development. That would be a sell signal if that trend line goes with conviction. And then we go back to that 60-minute chart and we start targeting all these gaps down below that haven't been backfilled. And if we don't get a breakdown, then we keep going up and we wait for a sell signal. There's the trend line right there, by the way. We need to break that trend line. There's a gap, 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 and another gap all the way down there. Let's just see what happens. We get a sell signal on the trend line. We'll go from there. As of now, make no mistake about it, we're clearly in an uptrend, and just one or even a couple days of negative breath on the market, isn't a screaming get out or anything like that, but it is again a heads up. QQQ, there's saying I already covered it, just continuing to diverge higher, walk its way higher. And on the daily time frame, I showed you that's the yellow trend line right there on the daily chart that I believe I have here on the 60-minute chart. There's your more significant longer term uptrend line. QQQE, equal weighted QQQ. You can keep an eye on that. Sometimes that'll give you a heads up. There's a trend line right there, and I think I had that same trend line. Yes, I do on the daily chart that I showed you earlier. So we're watching that one as well. IWM small caps, they're down. They're pulled back to this trend line right here. This trend line right there. Pretty much testing that trend line right now, down about 2% today. That's a big down day, but small caps are more volatile, so it's again nothing huge, especially as you can see, even during this uptrend we've had bigger down days. So really nothing technically significant yet. Could be tomorrow. One thing I point these out as potential patterns. Some materialize, some don't. We have an island cluster of candles right there. So should we have a large gap down tomorrow or anytime soon, as long as we still have an island, meaning 3 candles separated by a gap on one side, if we gap down, that would be an island top there, island cluster top. Again, just something to watch out for. And let's take a look at the breadth. Now here's the thing. When I sort these, let's sort them by yeah, I think I have all the, yep, I have it sorted by the losers. And so here's all the stocks that are trading red. I have to scroll down. We have 2,000 stocks, or nearly 2,000 companies. It's not a full 2,000. This is 1,958 in the Russell 2000. Still going, red, 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 red. There's one little green, but we have more red. Remember, this is real time. That's unique about doing this. You have real time market breadth, so you're going to see some ticks right about down here. Then you have several flats. So I'm just going to click around here. There's one of our trade ideas recently, MBII. I'll click on that one. That splits the difference really. Well, we start going green down here, so we could go all the way down here because we don't have any green yet. Either way, roughly 1,600 out of the 2,000 stocks on the Russell are red today, trading down. That's some pretty powerful numbers, and it's showing you a lot of broad-based selling across the board. And again, and you just started with the 11 sectors in the S&P 500, 10 of the 11 being down, and not just down a little. Most of them are down pretty good, well over 1 and even 2% on many of those sectors. Again, we looked at it over here. You have a lot of selling there. So that's what I'm looking at today. So now at this point in time, maybe I put a little bit more of an effort, or focus, I should say, not an effort. That too, kind of lost a lot of interest in trading the equity markets as actively as I had been, a few months back. They just haven't been that conducive. The pullbacks on the breaks have been very small, and they just kind of grind higher. But there's that little wedge on the S&P 500 futures. That's what we're looking at here. ES, little wedge break. This is a trend line we need to see go right here. So I'm going to make that a little bit thicker. There's a trend line, little wedge broke, and so we'll watch this trend line break. Where does that bring us? If it does break, I would say right here. Well, first of all, I'd be remiss not to give you this level. That is horizontal support, price support, about 3187.50 or so. So a break of that and the trend line would come together. That would be your sell signal if you're a futures trader, and this would be your initial minimum price target, at least mine, 31.28. And from where we're at now, that would constitute a drop of about another, what is that, 2.4% in ES. Let me just give you one more level in case it happens right there. I see some support, and I see one more level here that is likely to come into play. These are all likely support levels, where you most likely get a reaction on each level, on the initial tag of each of those support levels. And NQ, looking at NQ futures, I put a little X right here just to point out, because I like to do this and I talk about this all the time, how divergences are not sell signals or buy signals if they're positive or bullish divergence, like this one here. That was a divergent low back there. Buy signals come on breakouts above resistance, or sell signal comes on break of support. So I did point out that we had a divergent high here, but you can see it was negated. At this time, we had negative divergence, but we powered on through it, took it out without any sell signals. We needed to crack this trend line, and that hasn't happened yet. So we could probably even draw another trend line like this. But here we are. We have yet another divergent high in building. I don't have a very clean trend line to draw, nor do I have a very solid support level, but I'm going to give you one to watch that may do the trick. I would watch ES, and then I'll watch this level, roughly right about here, about 97.95 on NQ. Should do the trick to spark a drop, but as of now, make no mistake about it, we're still in an uptrend. No sell signals on the Qs, but again, this is probably the biggest divergence I've seen between the NASDAQ 100 and the rest of the stock market, and that includes, I don't cover it often, but the Dow, you can look at DIA, which is a Dow ETF. Same story. It's down 0.7% today, and has a very similar technical posture to the S&P 500 and everything else. If I can get that here, there we go. There's a little downtrend or uptrend line to watch. And that's it. We'll wrap up here. So we're in a market that certainly looks like it wants to go to new highs. It's not far from it now. There's pretty much last chance resistance, if you want to call it that gap. Of course, you have your previous reaction high, but when you get this close, you often punch through. But the thing is, if everyone thinks something's going to happen, it usually doesn't. How many people now, I'm sure a lot jumped on the train somewhere in here and said the market might go to new highs, but how many down here were calling for it? So, the market tends to surprise the masses, as this rally did, and, admittedly it's carried further than I thought it would, but the fact that we'd have a rally soon at this point wasn't at all a surprise. That was priced in the charts. What's going on now? Again, the technicals, yeah, they have been working. If you look at this, I underestimated the breakout above this trading range, even though I talked about it when we're in there that a solid break above would likely determine the next trend, and we did break to the upside. But again, so this part of the rally, like I said, has certainly surprised me, but not shocked me. And again, it's just the market has a strong bid beneath it. We have to recognize that, and we have some potential cracks today and the last few days with Treasuries and gold rallying, but you really need to see some key support levels broken to start anything more than just one of these small pullbacks we had. To leave it here, I should mention also, I just pointed out a minute ago a potential island cluster top on another security, but we also have that potential on SPY as well. Right here, because you do have a cluster of candles right there separated by a gap right here. So we could continue to build more candles, build the island, or we could gap down, and so something to be on the lookout for, a gap down below this island right here, down below about the 317 level. And unless that happens, and if it does, you have a confluence of the key moving averages below. You probably can't make them out, but they're all right here in this circle. I have my levels, the brightness turned down. 200-day simple moving average right here, exponential moving average there, and the 50-day simple moving or exponential moving average all down there. Those are levels to watch if we do get a reversal and a sell signal and start walking lower. Those are all about 200 simple comes in about 6% lower, and the 200 exponential and 50-day exponential come in about 7, almost 8% lower. So those are some potential pullback areas as well if you're targeting the next pullback in the market. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.